Welcome to Chapter 20 of the Canadian Securities course, Volume 2. In this chapter, we are going to be going over alternative investments. This chapter is quite complicated, and it is one that would be important to know for the exam, so I really hope this video is helpful. So first off, what is an alternative investment? So basically, they are asset classes that are different from the traditional three broad asset classes of equity, bonds, and cash. Now, they do break it down into three different groups. First off, you have the alternative strategy funds. Secondly, you have the alternative assets. So this can be like real estate, commodities, collectibles, and real assets. You also have a third group, which is private equity. So first off, we're going to look at the alternative strategy funds. You do have three different kinds here. You have the relative value. Basically, these strategies attempt to profit by exploiting discrepancies in the pricing of related stocks, bonds, or derivatives. You also have event-driven strategies. These strategies maintain positions in companies currently or prospectively involving in corporate transactions, so mergers, acquisitions, those types of things. You also have the directional strategy. This is where you attempt to profit from anticipated movements in the prices of assets, such as bonds, equities, foreign currencies, and commodities. Now, the second group is alternative assets. So these include a broad range of different assets. It could be commodities, real estate, collectibles, infrastructure, natural resources, and the list does go on. So that is just another type of alternative investment. You also have private equity. Now, private equity is mainly broken down into common stock, preferred stock, and debt securities of a firm. So it's a lot different than purchasing publicly traded stock or publicly traded debt because these are private companies. So there is a bit of a difference there. Now, what is the benefit of buying alternative investments? So number one, it does diversify the portfolio. Of course, these investments aren't correlated perfectly with your other investments like stocks, bonds, debt, stuff like that. And two, it does add alpha. So alpha is basically the risk-adjusted returns, and it will increase the portfolio's absolute return nature. And having alternative investments can allow you to reach that efficient frontier. And this efficient frontier, it is the curve that reflects the most efficient portfolios for all levels of risk. So basically, it is the best risk-adjusted return you can obtain with your portfolio. Now, there are some risks that do go along with alternative investments. First off, you have the first-order risks, which is the market risk or the systematic risk. So this just cannot be reduced by diversification. So alternative investment strategies won't be able to lower this. You also do have some second-order risks. So this includes liquidity risk. So it may take time to sell for some of these alternative investment strategies. For example, you can just think of real estate. Of course, that takes time to sell. You also have the leverage risk. So some of these alternative investment strategies, they do include getting loans and using leveraged accounts. And this will magnify your returns, but there are also some risks that come along with that. You have the deal breakage risk. This is the risk of loss from the failure of two companies to complete an announced merger. This is mainly a risk for the event-driven strategies. You also do have concentration risk. So this is when you have overweight your portfolio in one area. There is a bit of a risk doing that. There's a pricing model risk, which is the risk that the assumptions in the model are correct, and a trading model risk, where it is related to the failure of the systematic trading models. You also have some operational risk. This relates to the alternative strategy fund as a business entity, and it does stem from the fact that alternative strategy funds can be small and newly created businesses that depend on one or more high-profile managers for their success. Now, you also have hedge funds. Hedge funds is a type of alternative investment, and they are lightly regulated pools of capital with managers that have great flexibility. So it is important to understand hedge funds, and they actually do have some restrictions as to who can invest in a hedge fund. So first off, there are some exemptions, I guess, for you to be able to invest in a hedge fund. So first off, a minimum investment exemption is you need to invest at least $150,000. Alternatively, institutional clients with net assets of at least $5 million can invest, and individuals alone or with a spouse that own financial assets, net of the related liabilities that exceed $1 million, and you can't include real estate with that. Or you can be an individual whose net income before taxes exceeds $200,000 or $300,000 if you combine it with a spouse. So a bit of a specific rule there. Number 3 is the offering memorandum exemption. So hedge funds, they do always have offering memorandums. Basically, they're a lot like fund facts in a way for mutual funds. And these will allow purchase from non-eligible investors, but it is limited to $10,000. And so the purchase from an eligible investor is maxed at $30,000 of a limit. Whereas a purchaser is an eligible investor and received advice from a portfolio manager, your limit is then $100,000. Now with hedge funds, there are some incentive fees. So you have the high watermark and the hurdle rate. So the high watermark, it sort of works in a way so managers can't gain some incentive fees for the same type of performance. So if a fund ends up going down and then coming back up, they won't gain that basically that incentive fee from the increase getting back to where it already was. So a high watermark is the top of the market. It's basically the highest that hedge fund has reached, and the portfolio manager will get the incentive fee from the difference of the first high watermark to the second high watermark. So then if the fund does underperform, they won't actually gain any fees until it reaches past the previous high watermark. Now a hurdle rate, it is a bit different. It is the rate a hedge fund must earn before its managers are paid an incentive fee. So for example, if a hurdle rate is 5% and the fund earns 20% for the year, the incentive fees will be based only on that 15% return that is above the hurdle rate. Now we're going to look at some features that hedge funds do offer. So first off, hedge fund liquidity. So all hedge funds they're less liquid than mutual funds because they are priced and traded less frequently. So that's one feature about them that is quite important to know. Hedge funds, they typically are priced at the end of each month. So they aren't continuously priced at the end of each day like mutual funds, which is a bit of a disadvantage. And they sometimes have an initial lockup period. That's an important term to remember. And this lockup period, it usually lasts around 1 to 2 years. It's just if you invest money in the hedge fund, you'll have to wait the lockup period, so 1 to 2 years depending on the hedge fund, before you can actually withdraw your money. In terms of the hedge fund transparency, the level of detail provided is lower than mutual funds and ETFs. The frequency of communication is reported semi-annually, and the time between the fund reporting date and the date when the info is communicated to the investors is usually a 90-day delay. So essentially, hedge funds, they are a bit less transparent than mutual funds as well. In terms of investor protection, you do have the right to withdraw within 2 business days after they have received confirmation of their investments. And ETFs do not have this, but hedge funds do. Now, another alternative investment is liquid alts, an alternative to mutual funds. And the benefits of the liquid alts, they allow you access to investment strategies that were previously available only to exempt investors. And the goal of these liquid alts are to earn absolute returns during all phases of a market cycle. The transparency, daily liquidity, and investor protection rights that are associated with conventional mutual funds also do apply to liquid alts as well. They do have considerably lower minimum investment requirements than hedge funds. They're a lot like mutual funds in that way. And the low fees compared to hedge funds is another pretty good advantage. Now, the risk with the liquid alts is that not all alternative strategies can be offered within a liquid alternative structure. So some of these do have that lockup period that I mentioned for the hedge funds. Now, there are also funds of hedge funds or funds of liquid alts. And there are two main types of these. You have the single strategy fund of hedge funds. And this is when multi-manager funds invest in several funds that employ a similar strategy. So you'll have such as long or short equity funds and convertible arbitrage funds. So basically this just means you are investing in multiple different funds. However, they all sort of employ the same strategy. Whereas the other type is a multi-strategy, so you have multi-manager funds where they actually employ different strategies. Now, there are some advantages of the funds of hedge funds. First off, due diligence. So the task of selecting and monitoring alternative fund managers is time-consuming and requires skills. So having a fund of hedge funds, you'll just have all those managers looking after all of the funds. There is reduced volatility because you are investing in more than one hedge fund. Professional management, of course, all the managers for the hedge funds are professionals, and you'll have them looking after that. You do also have that access to hedge funds. As we mentioned before, there were some exemption rules, and it is difficult to invest in them. So the funds of hedge funds is a nice way to get into that. Ability to diversify with smaller investments. So there is a lower minimum investment requirement for the funds of hedge funds. And as well, the manager and business risk control. So hedge funds have fewer regulatory restrictions than more mainstream investments. There are also some disadvantages of the hedge funds. You do have some additional costs. So you might have some extra expenses for doing that. You also have no guarantees of positive return with a lot, which is similar to a lot of other investments. There's a low or no strategy and diversification. So if you aren't using that multi-strategy fund of hedge fund, then you aren't really getting that diversification. Insufficient or excessive diversification. So this sort of is the same as the previous one. If you are using that single strategy, of course, you might have insufficient diversification. Whereas if you are using a multi-strategy fund of hedge funds, you might be over diversifying. So this will actually hurt your returns. And there are studies that do show this. Hedge funds, they sort of do hedge their bets a little bit too much, and they do make money, but they usually do underperform compared to an index because of this. So it is important to understand that hedge funds do sometimes have this disadvantage. Additional sources of leverage. So some funds of hedge funds add a second layer of leverage, and this strategy adds to the costs and the risks. Now, there are some differences between mutual funds, hedge funds, and alternative mutual funds. First off, with the offering documents, first, just the conventional mutual funds, of course, they have their simplified prospectus, annual information form, and the fund facts. Now, hedge funds, they always have their offering memorandum. That's something really important to understand with hedge funds. Then you have your alternative mutual funds. So some of them are listed on the stock exchange. These are sort of like ETFs then, and they have a long form prospectus and the ETF FACS. And if they are not on the stock exchange, then they're the same as mutual funds. You have the fund facts, AIF, and simplified prospectus. For the fund net asset value calculation frequency, the conventional mutual funds, of course, they calculate it weekly. If using derivatives or short selling, if not, then it's just daily. And the frequency for hedge funds, it's set by the memorandum. It's usually monthly or quarterly. And with the liquid alts, it's the same as mutual funds. For fund holdings disclosure or transparency, with conventional mutual funds, you have a bit better transparency. They do show the top 10 security holdings monthly, and then quarterly, they will show you the complete fund holdings. Whereas hedge funds are a bit different, the disclosure frequency is set in the memorandum. However, it is typically semi-annual or annual. And with the alternative mutual funds or liquid alts, it's the same as mutual funds. And you'll find that a lot with the liquid alts. They are quite similar to mutual funds. So continuous disclosures, we'll just skip over that one. It's not super important, but just know that the offering memorandum really does show a lot of information for the hedge funds, whereas conventional mutual funds and liquid alts, you do need specific statements, so audited statements and whatnot. For the investment objectives, so mutual funds, they are looking for the maximum relative return, and hedge funds are looking for the maximum absolute return. They do like to provide a downside protection in falling markets as well. And liquid alts are the same as hedge funds. So there's a big difference there between the mutual funds, hedge funds, and liquid alts. Mutual funds look for that relative return, whereas hedge funds look for absolute return as well as liquid alts. Permitted borrowing. Mutual funds do have a bit of a restriction here. You have a max of 5% of the fund NAV at time of borrowing, whereas the hedge fund, it is set by the memorandum. And liquid alts, it is a max of 50%. So liquid alts, they are a bit more flexible when it comes to a lot of these things, which is why it is sometimes a good alternative investment. For permitted total short sales for the fund, mutual funds have a max of 20% of the fund NAV, whereas hedge funds, same, it's in the memorandum, and liquid alts, it's 50% of the fund NAV. For permitted short sale of a single issuer, it's max of 5% of the fund NAV with mutual funds. It's in the memorandum for hedge funds, a max of 10% of the fund NAV for liquid alts. Permitted total fund leverage. The maximum aggregate borrowing and short selling of 25% of the fund NAV at any time is the rule for mutual funds. So only 25% of leverage can be set for mutual funds, whereas hedge funds, it is in the memorandum. They have complete flexibility with that. And for liquid alts, it's 50%. For the aggregate gross exposure, the max aggregate borrowing and short selling is 25% for mutual funds. And it's actually 300% of the fund NAV for liquid alts. So they do have that ability to sort of make a leveraged fund, and they can do it up to 300%. So you can see how you can get some amplified returns with liquid alts. And just having that flexibility does make it an interesting investment strategy in some situations. For the cash cover for short positions, liquid alts don't even require this, whereas mutual funds has 150% requirement. Diversification concentration, you can have a max of 10% of a NAV invested in securities of any one issuer, as well as a maximum of 10% of the voting shares. That's for mutual funds, whereas liquid alts have a max of 20% in any one security and a max of 10% of the voting shares. So a bit more flexibility with the liquid alts there. And again, hedge funds, you can basically set all of this in the memorandum. For the limitation on exposure to alternative mutual funds, you can invest up to 100% of the net assets in other mutual funds with conventional mutual funds. And then with the liquid alts, you can invest up to 100% as well. For the investment in physical commodities, conventional mutual funds can invest up to 10% of the fund's NAV directly or indirectly using that derivatives. So it does count for their 10% of derivatives, whereas liquid alts are just allowed, no real limit. And there is a restriction to trade in a cleared specific derivative for mutual funds and no restriction for the other two. We're going to go over the derivatives for non-hedging purposes. So cash cover is required for mutual funds. Liquid alts are not required. Investments in illiquid assets, max of 10% of the fund NAV for mutual funds, and you have a hard cap of 15% for up to 90 days. And liquid alts are the same. For the rest of the comparisons, basically the alternative mutual funds, they are quite similar to mutual funds. However, they do offer a little bit more flexibility when it comes to certain restrictions like the short selling and derivatives and whatnot. Whereas the hedge fund, it really is just set on that offering memorandum. And the other really big distinction is the minimum investment size. So hedge funds, they do require that large minimum investment, whereas the mutual funds and liquid alts don't. So hedge funds are a bit more restricted, and they can be, or they can have a lot less rules and restrictions if it is mentioned in the memorandum. Whereas alternative mutual funds, they're very similar to mutual funds, but they do have less restrictions. So anyway, that is a full review of Chapter 20 of the Canadian Securities course. It is a bit of a complicated chapter, so I really hope you found this chapter helpful for your studying for the exam. And if you did, make sure to like the video and subscribe to the channel for more finance videos like this.